Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. Last week I recapped some of the details from my previous commentaries. The first pattern was the well telegraphed early March to early June sideways triangle. Not a good example, but it had merit. The primary target in the 953 area was achieved in June. Target X1, the harder to reach secondary target, is still live, and that's in the 700 area. However, I will retire it after this commentary, as it seems only the primary target was of interest. The second pattern was to regard the February 2022 to date action as a big M pattern. By using a more conservative high from May, this gave an already achieved primary target in the 866 area and a secondary harder to achieve target X4 in the 715 area. Likewise, in this case, as in the earlier triangle, the primary target was of interest, and I will retire the secondary target after this commentary. The most recent activity was the development of the July to September bear channel. This calmed the market down, yet still gave it a bearish tinge. However, in late August, the market broke up above the upper bear channel line, currently 792. Initially, this break higher looked like it would be capped by the descending short medium moving average, currently 824, and this moving average did do that. But after a week and a half, the market broke up through this resistance, thus legitimizing it as a definitive break higher from the bear channel. Prices next rose through a fairly free zone up to the next series of resistances, the 50% Fibonacci lines of the December 2017 to March 22 move at 887 and the May 2019 to March 2022 move at 891. These only lasted a week before being broken and converted into support. The next obstacle was the 50% Fibonacci line, the congestion around the September to 2019 to March 2022 move at 908. This has been tackled this week. It didn't last long. The market has now moved on to tackle a much more serious piece of resistance. It is the flatlining long moving average, currently 928. Also coincident currently with the November 2012 high at 930, and importantly, the slowly descending medium moving average, currently 931. So far, this long moving average has capped the rise, but it is still early. Now, all this move higher away from the bear channel has created another new pattern, an August to date ascending wedge pattern. This week, the top side of this narrow wedge was breached, but it has today repaired itself. However, this will be the next thing to look out for going forward. I have 4 final points. Firstly, beyond the long and medium moving averages, the next congestion is in the band 972 to 981, based around the 50% Fibonacci line of the March 2021 to March 2022 move at 978. Secondly, there is the possibility to look at the whole July to date action as a possible extended version of a V bottom. More on this should it develop. Thirdly, something I mentioned last time, and that was to look at the idea of a possible dead cross of the medium moving average down through the long moving average. This seems now not to be happening, and it will be unlikely I'll mention it again. Finally, we have the possibility here of a weekly key reversal. If prices close Friday, either over 875 or under 869, then we'd be on. Right now, we are looking at a weekly key reversal up. Chicago corn. Last time I asked you to consider 4 factors in this market's reactionary move higher that started in July. Firstly, is the reverse head and shoulders pattern over July and early August, I was initially not happy about it. It turned out to be actually a good pattern, and especially the neckline currently at 670. That has been incredibly supportive since the market broke higher over it 4 weeks ago. The primary target for this reverse head and shoulders pattern has already been achieved. We now have the secondary, harder to reach, but looking perhaps maybe not so hard, harder to reach target X1 still available in the 714 area. Secondly, and this was something that was already impacted the market, was the now flatlining but previously declining short medium moving average, currently at 637 even. What looked like a possible topping action back in August saw instead the market, how did I describe it at the time? See, the market stalled at testing it and pulled back to take a run at it, crashing through it, much as you would if you had a full supermarket trolley and rammed the doors. End of quote. The third factor is twofold. Part one is the same old 50% Fibonacci line at 661, along with the slowly rising long moving average, currently 678. Both had combined and tried to cap the market, but as they separated, they lost their joint combined power. At most, one can say the long moving average is now acting as a support. Finally, there is the July to date ascending wedge pattern, currently 658 to 707. Personally, I found this to be the most elegant of all the four factors I'd spoken about. However, it has become, how shall I put it, more fragmentary, with the most recent concentration being made on the upper trend line, and thus looking a little toppy and lopsided. Nevertheless, it is still an operational pattern and one that should be watched. Looking at where we are now, well, the market is testing the congestion area 694 to 700. Now within this is the neckline of the old March to June head and shoulders top, currently at 697. So you can see this area is giving some significant resistance since last week and causing this week to see intraday hesitation up to and including, if we include today, to the third degree. However, should the market break higher over this, then there's little in the way to achieving target X1 in the 714 area and in continuing the construction of the ascending wedge pattern. Thank you for listening. This weekly broadcast covers essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.